If you want to understand what a company is, like truly afraid of, or what they're secretly betting their entire future on, you do not look at their press releases.
No, absolutely not. You have to look at the filings.
Exactly. You look at the filings, and I have this massive stack of sources in front of me today. We've got market analyst notes, some historical research on corporate structures, and really the anchor of it all is this single SEC Form 10Q from May 29, 2026.
Right, for Penguin Solutions, Inc.
Yeah, for Penguin Solutions. And, to the untrained eye, it is just this dry, totally impenetrable wall of numbers.
Oh, it reads like a phone book if you don't know what you're looking for.
Exactly. But when you synthesize all this material, it reads like a strategic thriller.
It really does. You're looking at a company that's caught in the middle of this massive structural transformation.
Yeah.
So what we're doing today is decoding their financial DNA. Because when you cross-reference this filing with broader market trends, you see an organization that is, well, they're navigating explosive growth, they're quietly shedding dead weight.
And making these really sophisticated bets on the AI boom.
Exactly. Plus, they're untangling this web of just bizarre accounting consequences that trigger when you move a corporate entity from the Cayman Islands to Delaware.
Which is wild. So for you, the intellectually curious learner listening at home, our mission on this deep dive today is to figure out how Penguin Solutions is engineering their finances to survive and really dominate the current tech cycle.
What?
So let's start with just the sheer velocity of the money they're dealing with, because none of the weird accounting maneuvers we're going to talk about make any sense until you grasp the scale of their recent boom.
You really have to see the top-line numbers first.
We are talking about nearly $500 million in net sales in a single quarter.
Yeah, to put that in perspective, in the exact same quarter, just 1 year prior, they were sitting at roughly $324 million.
Wow.
So they have added over $150 million in quarterly revenue in just 12 months.
That's insane.
It is. But, the nuance is actually in the revenue split. The physical hardware, like the servers, the infrastructure, that jumped from around $258 million up to $414 million.
Okay, let's unpack this for a second. Because their services revenue actually went backward, right?
It did. It dropped down to about $63 million.
So they're shipping the physical infrastructure for this massive AI build-out at record speed, but, nobody is buying their consulting hours.
Exactly.
It kind of feels like they're selling the heavy-duty jet engines, but none of the airlines want to pay for the flight instruction manuals. Is that a bad omen? If a tech company can't sell its services?
Normally you might think so, but not in this specific phase of the technology cycle.
Why?
Well, the buyers for this level of AI infrastructure, they're generally massive hyperscalers. So think of the biggest cloud providers on the planet.
Right, the Googles, the Amazons of the world.
Exactly. They have their own armies of engineers. They do not need Penguin to hold their hand. They just need the hardware shipped yesterday.
Gotcha.
And frankly, from a business model perspective, hardware scales instantly. You manufacture it, you ship it, and you book the revenue.
Whereas
the services scale linearly. You can only bill as many hours as you have, actual human beings to perform the work.
So by leaning completely into the physical product, they avoid that whole bottleneck of having to hire thousands of consultants.
Exactly. And the bottom line proves the strategy is working. Their net income, their actual profit, went from a very modest $3.4 million in Q3 of 2025 to over $46 million in Q3 of 2026.
Wait, okay, a 13-fold increase in profit on a 50% increase in revenue. The math almost looks broken.
I know, it sounds crazy, but that is the mechanical beauty of massive operating leverage.
How does that work?
So a company has fixed costs, right? Their headquarters, their base R&D, their executive salaries.
Right.
Once those fixed costs are covered by your initial sales, every single additional server you sell drops a significantly larger percentage of its margin straight to the bottom line.
Oh, I see.
Yeah. So Penguin basically cleared their break-even point and is now just sprinting through pure profit territory. They are generating staggering amounts of cash.
Which kind of forces us to look at what they're doing with all that cash.
Absolutely.
Because supplying servers isn't their only play here. When you really dig into the footnotes of this 10Q, you realize they're operating this quiet, highly lucrative side hustle as a venture investor.
Yes.
There is this fascinating subplot involving a startup called Celestial AI.
Right. So Celestial AI was this privately held artificial intelligence company where Penguin had taken an equity stake.
Okay.
And then The consolidation phase of the AI boom kicked in, and a massive semiconductor player, Marvell Technology, acquired Celestial AI. This was in early 2026.
Right, so Penguin gets a buyout package out of this. They receive $10.5 million in cash, plus to just over 281,000 shares of Marvell stock.
Right, which is a nice payday.
Yeah. They record a massive $27.5 million gain on this early investment. But, and here's where it gets really interesting, they didn't hold the stock.
No, they didn't.
Barely 3 weeks after the deal closed, Penguin just dumped every single Marvell share they received for about $21.7 million on the open market.
Yeah, they liquidated it fast.
They even took a tiny, like, $500,000 loss on the stock fluctuation just to get the cash immediately. It looks like a classic hit-and-run investing.
It does look like that, except the transaction isn't actually finished.
Wait, really?
Yeah. So merger agreements in the tech sector, they frequently use something called a contingent earnout.
Okay, what is that?
It's basically a way to bridge the gap between what the seller thinks the company's worth and what the buyer is willing to pay today. So under this specific agreement, Penguin is entitled to receive even more Marvell stock if Celestial AI hits certain revenue milestones.
Right, I saw that in the filing. It outlines that if Celestial AI generates $500 million in cumulative revenue by 2029, Penguin gets a payout.
Exactly.
And if they hit $2 billion, Penguin gets like the maximum payout. So it is basically a lottery ticket stapled to a corporate merger.
That's a great way to put it.
But when you look at Penguin's balance sheet, they value this future potential payout at exactly $0.
Yep.
Zero.
I mean, if this earnout could be worth millions, why is it valued at zero? Marvell clearly believes this startup can generate hundreds of millions of dollars, so are the accountants just being paranoid?
Well, they're following a principle of extreme conservatism. It's dictated by this accounting rule called ASC 815.
Okay.
In finance, a derivative is just a shadow, right? It's an instrument whose value relies entirely on something else.
Right. In this case, Celestial AI's future sales.
Exactly. But the accountants applied a specific exception here because it is tied to a revenue milestone that hasn't happened yet. The philosophy is super simple. You cannot spend a maybe.
Therefore, you do not report a maybe to your investors.
Even if it's like a highly probable maybe.
From an accounting standpoint, highly probable doesn't matter until it crosses the threshold of being realizable.
Ah, realizable.
Right. They will only recognize that income when the milestone is effectively guaranteed. And if you step back and look at the broader context of the AI industry, this makes perfect sense.
Because it's so unpredictable.
Exactly. Predicting hardware demand 3 years out is nearly impossible. Supply chains bottleneck, compute requirements change overnight. New models require entirely different chip architectures.
So the accountants are basically shielding the listener and any potential investor from hallucinating revenue that might just never materialize.
Exactly. Keeping the books grounded in reality.
And, that same reality check applies to their failures, too.
Oh, absolutely.
Because venture investing is notoriously brutal. And the 10Q shows they aren't just minting money everywhere. They had to execute some pretty aggressive financial spring cleaning this quarter.
Yeah, you're looking at the impairment losses.
I'm looking at a $10 million black hole. They took a total write-off on this unnamed non-marketable equity investment.
Right.
And the corporate jargon in the filing, it blames, quote, significant leadership and governance changes alongside liquidity issues.
Which is the polite boardroom way of saying the founders started fighting, the company ran out of cash, and they drove the entire operation off a cliff.
Right. I mean, writing the asset down to zero has got to be painful, but I guess it clears the decks.
Oh, it does.
And they took it a step further with their international operations. They completely divested this Brazilian subsidiary called Zilia Technologies.
Yeah.
They sold the remaining equity to a company called Lexar Europe. But the math on this transaction requires some serious translation.
It's a bit tricky, yeah.
Because the gross sale was $46.1 million. After withholding taxes, Penguin was handed a check for almost $40 million in cash.
Right.
Yet, if you look at their income statement, they only recorded a $3.9 million gain. Wait, they got handed a check for nearly $40 million, but only recorded a $3.9 million gain.
Yeah.
That's like selling your house for $500,000 and telling your spouse you only made $40,000. Like, where did the rest go?
Well, this comes down to the concept of carrying value. And I actually love your real estate analogy.
Yeah.
Let's map this to something familiar, like that.
Okay.
Imagine you bought a house years ago for $460,000.
Right.
It has been sitting on your personal balance sheet at that value. If you sell it today for $500,000, yes, you are handed a check for $500,000 by the bank.
Right, which feels amazing.
Right. But
Yeah.
you didn't make $500,000. Your actual profit, your gain, is just the $40,000 premium over what you originally paid.
Because the baseline value was already accounted for.
Precisely. Penguin already had the Zillia asset valued on their books at $42.2 million. So when they sold it for just over $46 million, the true financial gain is just the difference between those two figures.
Okay, that makes sense.
But honestly, the dollar amount of the gain is secondary to the strategic motive here.
What do you mean?
Well, managing a tech subsidiary in Brazil requires immense executive bandwidth. There are currency fluctuations, local labor laws, completely different supply chain logistics.
It's a distraction.
Exactly. By liquidating this asset, management is signaling that they refuse to be distracted. They are trading a complex international footprint for cash that they can pour directly into their core AI infrastructure business.
Which they desperately need, because building massive computing architecture burns through capital at just an unbelievable rate.
Oh, yeah.
Which explains why they had to go out and find a strategic partner with incredibly deep pockets. In December of 2024, a major telecom player, SK Telecom, injected $200 million into Penguin.
Yeah, and they didn't just buy common stock on the open market.
Right. They purchased 200,000 shares of convertible preferred stock, which comes with board seats, voting rights, and this 6% cumulative dividend. I mean, Penguin paid out over $9 million in cash dividends just in the first 9 months of this fiscal year.
That's right.
So what does this all mean? Why does a behemoth like SK Telecom structure the deal this way? Like, why demand a 6% yield instead of just buying regular equity and riding the AI wave up with everyone else?
Because institutional investors at that scale construct deals to manipulate risk. Convertible preferred stock is basically the ultimate financial chameleon.
How so?
Well, the 6% dividend provides a floor, right? If the AI bubble pops or if Penguin stock trades flat for 5 years, SK Telecom still collects a guaranteed bond-like yield on their $200 million.
So they don't lose.
Right. But because the stock is convertible, they also retain the ceiling. If Penguin's valuation skyrockets, SK Telecom can just swap their preferred shares for common stock and capture all that massive upside.
So it is downside armor paired with an unlimited offensive upside.
Exactly. It's having your cake and eating it too.
It is a brilliant play by SK Telecom. But this specific $200 million investment triggered a really bizarre accounting crisis when Penguin decided to change their corporate address.
Yes, the U.S. domestication.
Right. So in June 2025, Penguin executed this domestication. They legally packed up their parent company and moved it from the Cayman Islands to Delaware.
In a legal redomiciliation of that size, it requires rewriting the fundamental DNA of the corporation. The articles of incorporation, the bylaws, the shareholder agreements.
All of it.
Yep.
And when they rewrote those documents for Delaware, they accidentally stepped on a legal landmine regarding SK Telecom's preferred stock.
They sure did.
Because under Cayman law, Penguin's board had protective provisions that gave them sole authority over when those preferred shares could be redeemed or cashed out.
Right.
But Delaware corporate law interprets redemption features and shareholder rights very differently. The new Delaware charter didn't explicitly preserve Penguin's sole control over that redemption timing.
Right. They lost the legal guarantee that they could hold on to the money indefinitely.
And because of that subtle change in jurisdiction, the SEC stepped in. They forced Penguin to rip this entire $202.7 million investment out of standard stockholders' equity and banish it to this purgatory category on the balance sheet called temporary equity.
Yeah, the SEC rules mandate that if an equity instrument has any mechanism, even a highly unlikely one, where the investor could demand their cash back outside of the company's control, it cannot be classified as permanent capital.
Okay, this sounds like moving to a new state and the new local laws say your roommate suddenly has the right to demand their security deposit back at any time.
Yeah.
So you have to keep it in a separate envelope marked temporary just in case, even if you know they aren't going to ask for it.
I love that analogy. That perfectly captures the mechanism here.
Wow.
Because the cash hasn't actually left Penguin's bank accounts, right?
Right.
And it doesn't change their ability to manufacture servers today.
Right.
But it drastically alters how the company's financial health appears to a bank or an analyst scanning the balance sheet.
Right, it looks worse.
Exactly. It increases their apparent leverage and makes their permanent equity look much smaller. It is this massive ripple effect caused by a purely administrative geographic move.
That's wild. Well, speaking of geographic moves on the balance sheet, let's look at the liability side for a second.
Okay.
Because we talked at the very beginning about how fast this company is growing, how much cash they are pulling in, and how their stock has been performing.
Right.
Well, it turns out that success has created a highly unusual ripple effect in their debt profile.
Ah, yes. You're looking at the convertible senior notes.
I am. So Penguin has roughly $148 million in debt that isn't supposed to be due until 2029.
Right.
Under normal circumstances, they have years to figure out how to pay that off or refinance it. But these are convertible notes, which means the people holding the debt can turn it into stock if the price hits a certain threshold.
Exactly.
And the contract states that if Penguin's stock price exceeds 130% of the conversion price for at least 20 out of 30 consecutive trading days, the debt holders get the unilateral right to convert the debt early. This goes through August 2026.
And the stock performed so well that it just blew past the trigger point.
Right. The debt holders now have the absolute right to demand conversion. And because that $148 million could be called in now, accounting rules force Penguin to move that massive liability out of long-term debt and directly into current debt.
Yep.
Hold on. You do a great job. Your stock price goes through the roof, and your reward is that $148 million of debt suddenly becomes due tomorrow.
Pretty much.
That sounds terrifying. If I'm a listener looking at this balance sheet at home, should I be worried about a sudden liquidity crisis? I mean, a 9-figure debt bomb just got moved to the front of the line.
I know it looks like a 5-alarm fire on paper, but you have to look at the other side of the ledger. This is what we call a champagne problem.
A champagne problem.
Yeah, it's a headache caused entirely by winning. It is the financial equivalent of your restaurant becoming so wildly popular that the fire marshal threatens to shut you down for being over capacity.
Okay.
The key is in their cash reserves. If you scan up to their current assets, Penguin is sitting on over $440 million in cash and cash equivalents.
So they have the money.
They have more than enough.
Yeah.
If every single note holder knocks on the corporate door tomorrow morning and demands their $148 million in cash instead of taking the stock, Penguin can write the check on the spot.
And still have, what, nearly $300 million left over?
Exactly, to run the business. So moving the debt to current is a strict accounting mandate, but in reality, it is a massive flex of financial strength. It proves to the market that their balance sheet is fortified enough to absorb a catastrophic early call on their debt without even flinching. It's not a crisis at all.
You've built an absolute fortress. And, it brings this entire analysis full circle. When we started, we were just staring at a dry SEC filing.
Just a wall of numbers.
Right, but the narrative hidden inside this 10Q is incredible. I mean, this is a company that physically and legally uprooted itself from the Caymans to Delaware, which triggered all those bizarre equity reclassifications.
Yeah.
We watched them ruthlessly trim their international fat by selling off a Brazilian subsidiary just to protect their core focus.
Exactly.
We saw them make a highly calculated, successful venture bet on an AI startup and lock in a multi-million-dollar gain. And on top of all that, we see them selling so much physical hardware that their own stock price is triggering early debt conversions.
They are firing on all cylinders. I mean, they have constructed this absolute war chest by acting as the logistics provider for the artificial intelligence revolution. They are laying the physical track.
Yeah.
But if we pull back and look at the historical precedent of massive technological shifts, from the build-out of the early internet to the proliferation of the smartphone, the companies that manufacture the physical hardware almost always face commoditization eventually. A server is just a server, right? And margins get squeezed by cheaper competitors.
So true.
The exponential long-term wealth is almost always captured by the software companies that operate on top of that hardware.
The people writing the code, not the ones pouring the concrete.
Precisely. So, as we project out toward the 2030s, the existential question for Penguin Solutions is not whether they can sell servers today. I mean, the 10Q proves they are executing that flawlessly.
Clearly.
The real question is whether they have a strategic pivot planned for the day the world finally has enough servers.
Are they content just pouring the concrete for the AI highway, or are they quietly developing a plan to set up a toll booth and charge everyone for driving on it?
Exactly. Are they building the roads or planning a toll booth?
Pouring the concrete versus building the toll booth, that fundamentally changes how you evaluate every future move this company makes.
It really does.
It definitely makes you wonder what the footnotes of their next quarterly filing are going to reveal. Well, thank you for joining us on this deep dive. Keep scrutinizing the numbers, always check the margins, and remember, The real story is rarely in the headline. It's always hidden in the fine print,